functioning. The last very point on this, again covering the basic element, is that this is not a one-time program. There has to be an ongoing effectiveness of this. And so basically if we compare our scenario of 2008 and 9, where the clause 49 was amended, and lately also in 2013, 2013 and 14 again there was an amendment to the clause 49 which was done. The very important element here is that the earlier part, when we were doing it in the earlier scenarios, right from, we are doing this not recently, but if you look at 2004, 5, 2006, 7, 8 and all this through, we have been doing this. But yet as we do IFC, a lot of improvements even for listed companies that we are noticing, which is only guiding us only towards one important point to be noted, which is that this program has to have an ongoing effectiveness. To ensure that this program has to have an ongoing effectiveness, for whole functioning of this program, there should be an internal single point of contact from the management side, which is particularly from the finance department, who will have to ensure that this program is properly driven and properly implemented and the real business value being achieved out of it. So all that needs to be done has to be done. So we typically say that do all that it takes to achieve the not only the compliance but also driving the value. And for that the management may think of engaging external consultants to ensure that this program is implemented, etc. But ultimately an internal single point of contact responsibility is very, very important to drive the business value and the benefit out of this program. So that is some of the very basic elements of the IFC that we wanted to cover for driving the business value, real business value. Coming a little bit more into further details into some of the basic aspects. What has changed? Is IFC something new? Is it an animal which already existed, or something where some enhancements have been done? So our point of view is that while a lot of this existed as requirements, there is a reinforced focus now by putting the responsibility to the board. The rigorousness and seriousness has improved a lot compared to previous times, and also putting it as a part of Companies Act, Section 134, as a part of the mandatory requirement, which earlier existed as a listing agreement, but now putting it as a part of the Companies Act, it is a very, very important step which has been taken. So to that extent, the program has a significant amount of enhancement compared to what existed previously. So there are some changes, as we already said. Clause 49 earlier only mentioned that this should be done through a CFO CEO certification approach. Now the Section 134 says that it should be a part of director's responsibility statement. So responsibility has shifted from the CFO CEO to the board of directors. Second important element which has got changed is the spectrum of coverage. So spectrum of coverage is defined right in the Act, which is Section 134, which is orderly and efficient conduct of the business. So what is the internal financial controls? It has been defined as something which is put in place by board of directors to ensure that there is orderly and efficient conduct of business, including adherence to company policies and procedures, safeguarding of assets, prevention and detection of frauds and errors, accuracy and completeness of accounting records, timely preparation of reliable financial information. So while earlier we had a term which is internal controls over financial reporting, now we are saying that it is a lot wider than what it used to be earlier, because you have included anti-fraud controls, because you have included policies and procedures, which means entity level controls and policies. You have included the accuracy and completeness of accounting records, which means some of your ERPs and some of the application controls, and the timely, of course, we assume that the timely preparation of financial information and accuracy and completeness part was already there, but there is a very, very specific definition element which is now included it, and therefore to that extent it is a significant enhancement from what existed earlier. There is another very important striking difference, which is that the earlier requirement was only applicable to listed companies. The new requirement is applicable for both listed and unlisted companies. Now, an important point to be noted here. Board of directors have to only put it as a part of director's responsibility statement for listed companies. But for statutory auditors, again the challenge is very different, because statutory auditors will have to go and attest not only the financial statements but also the internal financial controls, and that is applicable for both private and public companies. Now there are some references here which are very important to Institute's revised guidance note, which is categorical in saying that when we say internal financial controls, these are internal financial controls over financial reporting. So Institute's guidance note is drawing some of the references from across the globe, some of the matured countries in the world where the framework has already got implemented, like the US, Japanese SOX, let's call it JSOX, and some of the important other parts of the world, where the references are being drawn, and where very categorical, the term has been redefined in the guidance note, saying it is internal financial controls but over financial reporting. And what this means is that the statutory auditor's responsibility is largely limited to the financial controls, the financial reporting controls, and maybe something which is very critical that I just mentioned, operating controls, which is an example. Whether it is a financial control or not is a debatable point, but something like that is what also statutory auditor's interest would be, and which of course is going to be covered in the later part of the session on some of the technical discussions that we are going to have. But that is again a striking difference, that the requirement while under section 134 is only for listed companies, but section 143 is very much for both private and public companies. And therefore the point of view that may come out is why therefore in section 134 is a part of director's responsibility statement, why it is only for listed company and not for unlisted company. And that is something which is very important point, which probably maybe this difference may not exist, as some of the legal clarifications etc. may come later on. But that's a very important question, why for board it is not there and why for auditors it is there. And it becomes particularly challenging for the auditors to drive and come up to a point of giving opinion when the directors do not have the ownership of it. So how do statutory auditors will report on it? Because any qualification, statutory auditor will have a challenge reporting it, particularly when the board is not adequately having a responsibility on it. So these are some of the elements about what has changed. Going little forward on some of the, one of the parts of the basic aspects. What is most important? What are the core implementation issues that we face? What are the core implementation issues that we may face on this? The core implementation issue that we face is that, look at from an Indian context, most of the Indian companies are very good when it comes to controls around purchase orders, controls around payments. So every purchase order which is committing the organization for any liability, I think we have got a well-defined authority metrics around purchase orders, well-defined authority metrics around payment controls. Any payment that goes out of the company is got well authorized and well signed off, and whether you've received the service and people have authorized it, and so on. But all that happens between the two and after the payment, all that happens before the purchase orders, like purchase requisitions and so on and so forth, the planning aspects, etc. Where does all of this go? And that is where it is very important to understand that while we may be good on purchase orders and some of the elements like payments, how do we make sure that there is enough coverage of all elements within the IFC, some of the important elements within the IFC, where we believe it's IFC, it should be covered. Not just purchase orders and not just the payments. Now, the core issues that we find is, do we have enough documentation to prove that we are following the controls? You may be following controls, but you don't have a documentation. So that's one of the core issues. Second important issue is what is the extent of documentation that we need to maintain as internally and for the statutory auditors, and what is the extent of documentation that the statutory auditors need to maintain to support their opinion on adequacy of internal financial controls. What is the extent of documentation that is needed? The third important element is, in SOX we always used to say that if you don't have documentation means that there is no control, and we would like to draw probably that reference. You may keep crying about, okay, I have control, this control is operating well, and there is no payment which has gone without receipt of service or without receipt of goods or without authorization, but all that is needed is that there is a good amount of documentation, and no documentation means no controls, and which is another important point. Again, one of the fourth issue that we believe is very important is, and I have already mentioned that previously, is to what extent does the finance department drive this program, and to what extent the business operations from different teams other than finance team would take the responsibility. So that's another implementation issue that we encounter, and to overcome this, it's very important that everybody is bought into this program, is made well aware about this program, is sensitized about this program, and again, if there are elements which are not working towards this direction, then taking adequate disciplinary measures is again a very important point to drive, and that's again a part of the entity level controls. Going forward, there are some key considerations that have to be thought through in implementing this whole program. One is, what is the classification of control into critical, key and non-key? What are we talking about? Are we talking about key controls, or we are talking about even some of the micro controls at the lowest level? So that is an important point, and it's up to the company to define it. While for the reporting to the board and to the statutory auditors, our recommendation is to ensure that you include the key controls which are critical and high controls, and not going out and include every non-key control, because for non-complying with a non-key control will have its own repercussion. Categorization of controls is very important into anti-fraud controls, entity level controls and financial controls, because that is where we are going to prove that each and every element which is defined in the definition has got covered through this categorization. To what extent do we rely on entity level controls and the process level controls? Like, there are places where we may do a very heavy dependence on entity level controls vis-a-vis places where we will depend heavily on the process level controls. So what is the extent of reliance on entity level controls? To what extent do we rely on IT general controls and application controls? Do we really go out and test it every time because these are embedded into the system? Does it need frequent checking? The answer could be probably no. We may not need a frequent testing as much as some of the manual controls, because they are there in the system, because it's a part of the system process. So it may not need as much of frequent testing. It may need testing once in a year or once in a 6 months, and again that frequency is left to the business. But that is again important. To what extent IT general controls and the application controls have to be tested, and what is the extent of reliance? Another important key consideration is the careful application of the second line of defense and the third line of defense. I already mentioned about COSO. And one other consideration which I already again mentioned was that for deriving the real business value, it may not be just a small IFC set, but it has to be a larger management set that needs to be looked into. So while for financial reporting, for reporting to the board, for reporting to statutory auditors, there may be a subset of financial controls, which could be about 150 controls. But for management to really drive the value, even some of the other controls like moderate operating controls or moderate level anti-fraud controls, those are the controls that can be included in the management set, and which is how the organization can really improve the discipline around internal controls. Just going back to also what CARO requirement of 2015 is enumerating. Caro's definition of internal control is not on financial controls. It's just internal control system over some specific elements like purchases, inventory, sales, etc. But it's to that extent it is not just financial, but it is also including operating controls. So it is important that even if you to comply with Caro requirements of 2015, then a very important element is to also include the operating controls, some of the important operating controls, and make it a larger, wider set, which is a management set, which is what many companies at the time of SOX did, because that gives an opportunity to improve the overall discipline of the controls and not just look at a very narrow aspect of just IFC. And the last important consideration that you need to bear in mind, which is an important one, is the whole selection of the critical and the high controls. When we say critical and high, they would be the key controls. So selection of critical and the high controls should be based on the inherent risk and not the residual risk, because residual risk will be considered after after the controls that you already have. But inherent risk is what is the inherent risk of a particular thing happening if the control did not exist. What is the inherent risk approach? So basically going into the gross impact and the gross likelihood is what inherent risk is going to throw up some of the critical and high controls. So this was a very important consideration. There are some principles which are now, of course there is a revised guidance note and they are very well enumerated, which is again some of the principles that need to be borne in mind when you talk about IFC and when you talk about compliance around IFC, is that adherence to just the written policies and procedures is not going to be enough. You need to be operating controls in the real spirit. Auditors and the directors will largely be looking after reasonable assurance, and that's what also guidance note says, and not an absolute assurance. The attestation date is the balance sheet date, so all the controls have to be operating on the balance sheet date. So therefore there could be parts of the year that it may not be operating, but most important is that on the balance sheet date the controls need to be operating, and therefore there has to be, for example, if we talk about March 2016 balance sheet, then the attestation is going to be as of 31st March, and therefore controls have to be operating as of 31st March 2016, and for which all the backward working has to be done. And our point of view here again is that it would be good to ensure at least 1 quarter of effective implementation with proper demonstrability. So if the organizations have may not have started the process, need to start the process to ensure that the completion is achieved in 2 or 3 months from now, so that by 31st December the program is fully implemented, 1 round of testing has been done, and then there is 1 quarter of effective implementation that is left. IFC requirement, again in the new guidance note, a very important clarification has come, which is that it is applicable to all the entities at an entity level. So a company may have 5 subsidiaries. So it is not just the holding company. It is in every company which has to have an internal financial control. So it's an entity level requirement, a legal entity level requirement. Any company which is registered in India, including a one-man company, etc., all of these will have to have compliance for internal financial controls. An additional element that has been brought by the revised guidance note is that the holding company, that is a parent company, in addition to its own entity level IFC, internal financial controls, have to also ensure that there are, for the consolidated financial statements reporting, adequate internal financial controls are identified and are implemented for consolidated financial statements. And this may not be the controls which may be operating in your books, but which may be operating outside the books for the consolidation level. And that could include typically things like spreadsheet controls and Excel sheet controls, etc., which may be important for ensuring compliance. Again, a very important element which has been clarified in the guidance note, which is that IFC framework is different from ERM framework. So if you have done an ERM framework, doesn't mean you are compliant with IFC, and if you have done IFC, doesn't mean that you are compliant with the ERM framework. Last important clarification again is that material weakness in IFC does not mean material misstatement in the financial statements. So coming to very quickly on the scoping of IFC, what should be the scope? So there are three most important things if I have to just summarize the entire scope of how this activity has to be done. So the scope of IFC has to start with first doing a control gap assessment, and that is the framework level gap assessment and the entity level control gap assessment.
Hello.
Second is develop a robust internal financial control framework, and by framework we mean defining a proper policy document, a responsibility statement, methodology around control testing, sampling methodology for control self-assessment, and the whole control self-assessment framework, ownership of controls, and the testing frequency. So all of this is going to be a part of internal financial control framework. The third most important element and the last element is ensuring the risk and control matrices for process level controls. So very typically you may not need all kind of standardized operating procedures, SOPs for all parts of the business. What you would need at bare minimum is that there are some core reporting elements or financial control elements that would need certainly a detailed standardized operating procedure document, but definitely you would need a risk and control matrices for all the parts of the business and see from where all the financial reporting risk is emerging or an IFC risk is emerging from, and have we mitigated, do we have enough controls now or do we need to add to adequate controls, and that can be only possible through using a proper risk control matrix. An important point again here is that when you drop a risk and control matrix, there has to be adequate mapping right to the general ledger codes from the trial balance to ensure that there is complete coverage of all important significant accounts and balances. So in the revised guidance note of the institute, there is a reference of significant accounts and balances, and the risk, and so all those accounts which are identified as significant accounts and balances, the risk and control matrices have to draw adequate mapping of the risks and the controls to the ledger accounts through the RCM. Just to go maybe one more point forward on what is significant accounts and balances, and that is about materiality concept. Now materiality concept has been defined by the institute earlier in some of the other pronouncements and some of the other standards and resources published, which is, let's say, 5% of materiality, something like a 5% materiality, and applying a haircut it could come to 3.5% of materiality. So meaning that anything about 3.5% of profit before tax, and it could be also in some instances you can define a profit after tax could be a material item. So any control which is important to ensure that there is not more than 3% of misstatement happening is a material and an important control. So we typically our point of view here is that if you have to say key control, then a key control could be 3 to 5% of the profit before tax or profit after tax, and above 5% could be a critical control. So you will have two classes, one is high and the other is critical. High could be 3 to 5 and critical could be 5 and above, and both the critical and high could be a set of key controls. So this is how significant accounts and balances would be derived based on the materiality threshold. Entity level controls, and now coming to the next point is to what extent do we cover upon the entity level controls and policies, which is where the heavy reliance is to be. So our point of view here is that there would be and we are not going to go and say that in every instance you would need, let's say, something like a entity level control like a KPI framework, for example. In all business, and it depends upon business to business, but it may not be needed in all business. But certainly something like a code of ethics policy, whistleblower policy, related party transaction policy, business continuity plan, MIS reporting, segregation of duties, delegation of authority, training and development framework, all of this could be some of the important entity level controls that upon which the reliance would be placed for adequate effectiveness of internal financial controls, and which is again going by the definition of IFC, orderly and efficient conduct of the business, where entity level controls play a very important role. Just to reiterate one particular fact in a little more detail that we have already covered, IFC set. I have already said that the core IFC set is going to be key and moderate operating controls, the core IFC set is going to be key and moderate financial controls, key and moderate reporting controls, that is the book closure controls, provisioning, period end provisioning, etc., accruals, etc. Key anti-fraud controls, key entity level controls, and key operating controls. And the management set will include IFC set plus moderate anti-fraud controls and plus moderate operating controls. So this is how the scoping spectrum would be looking like. There is an IFC set, which is the bare minimum for the board and for the management and the statutory auditors, but there is a management set from where we are going to derive larger business value. There is an implementation approach, so we recommend this whole activity to be carried out in 3 phases. Phase 1, which is the scoping, assessment, documentation and rollout, which are the sub phases. Phase 2, which is testing, and phase 3, which is automation. As I just said that control self-assessment tool can be used as a tool to automate this whole process, and that can ensure that all different parts of the business are doing a proper self-assessment through a tool, and reporting is a part of the tool. Any non-compliances are reported as a part of the dashboard through the tool. So that's an automation process, so that the communication etc. can go through the tool. But as I said, which is not mandatory, but which is an important way to mature in the long run for implementing IFC for ongoing effectiveness. But phase 1, scoping, assessment. So first part is the scoping, second part is doing an assessment, which is the gap assessment, then the documentation and rollout, then doing the testing of the controls, that is a phase 2, and then automating the entire workflow. So, so this is about implementation approach. There are couple of core questions, that may come in, which is some of the questions that we would, of course, these are not the questions from the participants, but these are the questions that we have already thought through. Is how different is this from SOX? Is it really a replication of SOX? And while we would tend to say that there is a very important reference point from the SOX, which also the revised guidance note of the institute has taken a reference of, which is the PCOB auditing standard 5 and the requirements in the US, etc. There's a good learning experience that we've already got, let's say, as internationally, let's say, by implementing SOX. But is it same as SOX? So fundamentally the concepts with the SOX are same, but it is not necessarily the same as SOX, because I already said that SOX is applicable mainly for listed companies in the US, whereas IFC is applicable even for non-listed companies. Similarly, SOX is at the US consolidated level, the companies which are listed in the US. In India, IFC is applicable for entire entities, all sets of entities. So there are some striking differences. While there are important concepts from where the references can be taken with SOX, but it is not necessarily same as SOX. So if you have done SOX, doesn't mean you have complied with the IFC, but there may have to be certain additional enhancements which have to be done, because the materiality in the case of a SOX company will be 5% of, let's say for example, 5% of the consolidated statements which are published in the US for NASDAQ and for NYSE, New York Stock Exchange, but in India, it would be applying at an entity level. So this is a very important striking difference vis-a-vis SOX that has to be kept in mind.
Is the heart of the SOX and the IFC same?
So to answer that, yes, the heart and the conceptual framework is somewhat similar. Is somewhat similar, other than the definition part, etc.
Materiality point may be percentage difference may be there, but
no, even materiality to quite an extent is more or less similar. It's not much different, but the whole definition element, the responsibility element, like CFO and the CEO certification is what is used in the US for SOX and for most of the mature frameworks. Here we have got directors reporting in. So there are some of those structural differences, but as you rightly said, the heart is common.
moving up, in fact, the ladder, in fact.
Yeah. So let me end my session, my part of the session, by making one statement that looking into also the spirit of the Companies Act, and of course the level of the guidance note issued by ICAI. The framework that is expected in spirit from the legislation in India out of Companies Act and the guidance note is relatively far more advanced, and it's relatively far more rigorous compared to some of the other frameworks, because you're saying you're making directors accountable, you're doing it entity level, so it entity level to all parents as well as subsidiaries, even though you're not listed. So the framework is far more rigorous compared to what you would have in other parts of the countries, other parts of the world. So that is an important point to be noted. But having said that, I would pass it on to my fellow colleague to take it forward for other technical matters and related areas.
So, really, you've taken up the series well, in fact. Right, first you have taken it from the management's perspective, and now we'll have to understand it from the auditor's point. So, Robin ji, you can.
Thank you, Kartik. So, as Kartik, laid down pretty much the entire very concrete ground in terms of why IFC, what is the responsibility of the management and the board of the company to both create preparedness, define their headset on IFC. What I would sort of elaborate more on is the auditor's responsibility. When I say auditor's responsibility, you mean the statutory or the external auditor's responsibility. And how does that thread starts once management activities conclude. First, let's touch upon the definition itself under section 143.3.1, that the auditors need to assess whether there is an adequate internal financial control system in place and whether it is operating effectively. As we saw, the director's responsibility was, as business, the board's responsibility is to implement it, ensure adequacy, ensure operating effectiveness.